Hey everybody, what's going on? My name is Danny K, and this is another episode of Blockchain Breakdown. Today I'm going to do a little bit of more news and things that I found interesting, and just kind of give you some of my thoughts. But yeah, without further ado, we can just jump right into it. The first article that I checked out was that CNBC's Jim Cramer explains that now he is bullish on Bitcoin once again, and he has bought in around the $17,000 level. The former hedge fund manager actually has flip-flopped a couple of times in terms of how he felt about Bitcoin. Initially, in I think it was June of 2017, when Bitcoin was trading around $2,800, he basically said, "Well, I think Bitcoin could reach $1 million because the European banks are frantically trying to buy them so they can pay off ransomware. It's a short-term way to be able to deal with cybersecurity. Is the way to pay off the bad guys," which I think is kind of a really weird thing to say about the only value of Bitcoin, which goes to tell me that at the time he definitely did not understand the full scope of what Bitcoin was and its value. And so he was at that time bullish on Bitcoin, but then he cuts to August of 2018 when Bitcoin was below the $6,000 level price, and he says, "I think the tide has turned against it. I'm not saying its time has passed, but there is a notion that the sun seems to be setting." So far it looks like, I mean, granted, let's say he bought at 2,800 and then sold at the 6K level, yeah, he still made profit, but I think it just kind of goes to a weird mentality where he, in a way, almost bought high and sold low, even though it was a profit. And I say that because he bought high at 2,800. That was the first time it had hit that level, and no one knew where it was going. So he bought at that. Hypothetically, let's say he bought at that level, and then when things started to go bad at 6K, he was like, "All right, well, I'm out," which was pretty much, I mean, it was 50% away from the actual bottom, but from the all-time high, it was a minuscule amount of percentages going down to 3K. But that's not the point of the article. The point of the article is that in September 10th, Jim Cramer again changed his mind, and we found out because Anthony Pompliano, the Pomp podcast, put out a tweet that said, "Just convinced Jim Cramer to buy Bitcoin. Reply to this tweet with your best meme or GIF to the world's newest Bitcoin owner." And to kind of fill out why Jim Cramer finally decided to buy back in at 17K, which makes you, again, sold low, bought high, he said, "Yeah, I felt that back at $17,000 seemed like a decent level, and I will buy, like I usually do as something comes down. I'll get bigger and bigger and bigger. I just think you want to diversify into all sorts of asset classes. I have gold. I'm going to diversify into some Bitcoin. Not a big position for me, but it's certainly important to be diversified." I also want to throw in here this comment that I think is really funny. Down here it says, "If Cramer had focused on Bitcoin's total hash rate instead of price chart action as the indicator of Bitcoin's future performance, he would have not waited to 17,000 to buy, but he would have probably bought in a lot sooner." And this guy brings up a really great point, that when you're looking and trying to forecast the future of Bitcoin, it's not necessarily the price. I mean, while the price is a great indicator, and you definitely it influences a lot of people's decisions on when or when not to buy, but you got to remember there's all these on-chain analytics, and when you see the mining rate and the hash rate of the blockchain just keep going up and up and up, and you see a higher number of active wallets, and you see a higher diversity of wallets, and you see a higher amount of transactions, that shows you that there's more and more people using the network. So obviously there's something there. But to kind of tack onto this, and it didn't really get much press, but this guy, his name is Pury. He is senior director at Twitch, the largest streaming platform at Amazon. And he basically went out on a tweet and said, "I put 25% in Bitcoin." And they said, "What do you mean 25%? And then he went to follow on to say that he put 25% of his net worth in Bitcoin. So here's just another individual, a high net worth individual, that's realizing that the tide is changing and that there's a whole new world of assets out there that you need to be putting your money in. I mean, obviously, we all know about Mass Mutual just recently bought $100 million worth of Bitcoin last week. The Massachusetts life insurance giant. We also know MicroStrategy basically laughed at Citibank's rating because Citibank basically said, oh, we're downgrading your stock and because you're buying too much Bitcoin. And MicroStrategy was like, sweet, I'm going to buy more Bitcoin. And it actually is doing pretty well. So I think it's definitely high time for people to realize that there is a very big change in the tide of what the perception is about this asset class. And following that up is a little bit of MetaMask DeFi news. So for those of you that don't know, DeFi and MetaMask is a wallet that kind of integrates within your web browser, and it's used for is that it interacts very well with decentralized exchanges, thus offering you non-custody exchanges to swap your tokens. And most of you probably know that DeFi has taken off like hotcakes this past summer, and we've seen more and more money being poured into the DeFi space, locking up assets for yield farming and things like that. Well, now Consensus, the creators of and developers of MetaMask, wants to offer an institutional grade version of MetaMask for DeFi users for institutional firms. So basically, this article says, as the DeFi space continues to grow, Consensus has now announced a new offering from the leading wallet provider MetaMask. It will enable cryptocurrency funds, professional traders, and custodians with institutional-grade controls and applications for decentralized finance. That is amazing. I mean, that if you don't grasp at how huge that is, so this is basically saying that large institutions that don't want to put their money, because listen, if you think about, if you have JP Morgan and their crypto trading desk, they don't really want to put their assets on Kraken or Coinbase or Binance for that matter, because that's just an additional risk. Here is now this is going to be a product that allows them to get into the DeFi space and maintain custody of their coins, just like we all enjoy using a decentralized exchange, and still be able to trade and swap. So the blockchain technology solution provider announced that we were offering a new wallet oriented towards growing spaces in the decentralized finance. I messed that sentence up a lot. But data from DeFi Pulse shows that the total value locked in various protocols is now over 14 billion, charting an increase upwards of 2,500% since the beginning of 2020. And if you think 14 billion of locked assets in protocols is a lot, wait till you see institutional investors get into the space, which it's going to be crazy. As such, custody providers seek increased exposure as well as access to the diverse opportunities that DeFi brings, but the current process remains inefficient for professional trading firms. And in an attempt to solve these pressure points, Consensus will be offering crypto custodians and trading firms an institutional-grade version of MetaMask. I think that this is insane. This is a really, really smart. Honestly, it's a really smart move on Consensus, and it actually just makes perfect sense. Like, of course, that they would cater to the institutions, and I'm sure the institutions were like, oh, hey, we want to do this, but we're not gonna put all sorts of stuff on a centralized exchange. And well, here they go. This is the solution. So this is just another article on it from Cointelegraph, but it pretty much just says the same thing, but they also said, where was it, that the digital asset custody firm Curve will be the wallet's first user. So they're going to be incorporating the new MetaMask wallet to build its new Curve DeFi product, which will be used by the firm's existing clients, including eToro. So I think that that's pretty cool. Good thing to know, especially about the Curve protocol being kind of the first ones to take the plunge on this institutional decentralized wallet. But yeah, I think that this is actually pretty cool and amazing in that we are going to see a rush of more assets getting locked up into these DeFi trading protocols. All right, next up is a little article. I'm just going to brush over it real quickly. It's about Apple's co-founder Steve Wozniak and his token called WozX in the eForce company. Essentially, his token basically launched last week, and a lot of people were really excited about it. And it jumped, I think, over 1,500%. Once it got listed both on BTC, and then the other one was a BitThumb. And I think that is actually pretty interesting. I think it pulled back about 40% from its all-time high, but still you think like that's a pretty decent gain. But essentially, for those that don't know, Wozniak basically launched a new company called eForce. Basically, it's meant to transform and disrupt the energy efficiency market. And like it says, it got listed on HBTC on December 8th and then BitThumb shortly after. So one thing, too, I'm going to note, and I'm actually going to get back to what the project is, but one thing is, meanwhile, in a recent interview, Wozniak, one of the 6 eForce co-founders, said he doesn't know how many WozX he owns. In quote, he says, "I don't personally know how much I have for eForce. I'm not operationally involved, and I avoid financial considerations." And then he added that, "I like to think of our tokens as shares of stock." I think that's kind of interesting to say, it makes me wonder, okay, is Steve Wozniak really in the progression and development of this eForce and this WozX token, or is he just kind of on it and then is like the front runner? I think I'm going to have to dig a little deeper in there. But to just kind of give you a little better idea of what this token is, here is a really good... He basically said, this is another quote from Wozniak, he said, "We created eForce to be the first decentralized platform that allows everyone to participate and benefit financially from worldwide energy efficiency projects and create meaningful environmental change." So it's obviously a platform for helping the environment, becoming more energy efficient. How they do that, I have no idea. I'm just interested to see what this coin does. I don't own it, and I don't plan on owning it, and that's not an endorsement or a anti-endorsement, but I just think that it's interesting to see Steve Wozniak getting into this space. He's always been pretty pro-Bitcoin, but getting into this space and then doing something like this where it is, about helping the environment. I'm just interested to see what they eventually offer. Obviously, like I said, this is very, very new, and not a lot has really been given out about the specifics and details about how they're going to, create energy efficient projects and things like that. So I think that would be interesting to see. In news that I think is kind of funny, but also not funny, it's kind of unfortunate. Basically, there have been a number of validators getting slashed basically after the Ethereum 2.0 Phase 0 launch. And here it says just day after, but I think that is actually a typo. I think it was not the next day after, but it was a couple of days after. Though since the Phase 0 launch, according to Beacon Scan, there's been one validator that had already been slashed, but now, and that was on December 1st, but now I think there's about 16. I have it over there. I'll take a look at it. The Beacon Scan states that a validator that is caught acting maliciously will be slashed, penalized, and eventually forced into an exited state. Rewards and penalties are efforts meant to protect the network against potential malicious attacks. So what that means is that when you get slashed, you're basically fighting against the network, and you're trying to put malicious blocks on the network. And then I also think that you could possibly get slashed if your validator goes down for an extended period of time, and I'm not talking like an hour or two, I'm talking like a couple of days. So I have to double check on that one, but I believe that's also a caveat into getting slashed. But I know that when your validator goes down or is disconnected from the internet, you definitely get penalized, which is like a docking of the fees that you would earn. But so this is actually pretty interesting to see. Here's this tweet that says, Jesus, a lot of Ethereum 2 newbies are getting savagely slashed, except when you look into this, which I did. Hold on, where is it? I'll just pull it up here. And you look at what this chart actually shows. This specific chart actually just shows penalizations, right? So the guy that was posting it didn't realize this is actually like penalizations, but still, like on the first day or so, or the second day of launching the Beacon chain, seeing this many people getting penalized is kind of off-putting. And then if you go over here, this is a list of all the slash validators, and we have a total of 14. A lot on the first day, second day, and then a couple this week. So I don't know. I think that's kind of interesting. I myself would love to run an Ethereum node, but I also realize that I don't know if I actually have the infrastructure to do that. Like, you need a very good internet connection 24 hours a day. You need to be able to monitor that network. You need to be able to, code and fix out any kind of bugs that, maybe your network is like glitching or something like that. So I'm decent with computers, and I've been slowly trying to teach myself like Solidity and how to like execute smart contracts and things like that. But I don't know if I'm confident enough to do an ETH 2.0 or ETH 2 node. So I don't know, just one of those things. If you are thinking about running a node, it's not as easy as like setting up a computer and letting it go. It takes a little bit more work, and as you can see, there's people getting hit already. So there's that. And then lastly, we are going to talk about the first CoinSwap test that could start the era of a stronger Bitcoin privacy. Now, as you may or may not know, I'm a huge fan and strong believer of your natural-born right to have privacy, especially privacy with what you do with your money. So, with that being said, CoinSwap is a promising Bitcoin privacy technology was finally put to a test on Tuesday. And so a big day for Bitcoin privacy and fungibility, treated Bitcoin privacy developer Chris Belcher when announcing that the transactions. So basically what CoinSwap is it is going to be this new kind of protocol that goes onto, and we'll get into my opinion at the end of this because I have a lot to say on it, but CoinSwap is essentially a very similar protocol to, I don't know if you remember CoinJoin, but essentially it's, let's say you have a transaction of 1 Bitcoin that you want to send. Well, your Bitcoin goes not to your wallet directly, but goes into this pot of all sorts of other Bitcoin. It gets shooken up, and then you get sent either 1 or 10 or 100 transactions to your destination wallet, and it basically will then total your 1 Bitcoin minus your transaction fee, right? So that it's supposed to make it very difficult for companies like Chain Analysis to decipher where those coins have originated from, right? However, I don't think that this really is the case anymore. I think Chain Analysis, at least they allege that doing things like CoinJoin and tumblers and things like that really don't, basically it doesn't really interfere with their ability to detect where the coins originated from. But the difference with CoinSwap here is it does exactly what CoinJoin does, but it makes the transactions invisible to the public blockchain, right? So you think, wait, what? That's crazy. Is that Monero? No. In fact, what it actually does is it makes it look like, transaction A and transaction B happened directly, but the fact is that all this CoinJoin shuffling stuff is happening under the hood, and there's no way for that data to actually be transmitted out to the blockchain, so Chain Analysis doesn't have access to it, thus they can't analyze it. So I think that that's a really interesting thing to think about. And I think that, like I said, privacy is really important. But let's say this works 100% the way that it's supposed to. Okay, like let's say they get it done and it is flawless and it destroys Coin Analysis or Chain Analysis ability to track your spending and all sorts of stuff like that. There's a couple of problems. One, you're gonna have to implement this protocol onto the blockchain, which you can do, but then you're going to have to convince all the miners to mine that new chain, if you do, whether it's a hard fork or if it can be implemented with a soft fork, if that is what the route that they want to take it, if they want this to just be a private blockchain altogether, I would love Bitcoin to be a private blockchain altogether, but unfortunately, we have a number of institutional and governmental interest or governmental agency interest in Bitcoin, and there is no way in hell that they will allow Bitcoin to ever go dark or go private like that. So unfortunately, if that's the way that it's implemented, I don't see it be successful. Now, if this CoinSwap was implemented in a way where you can opt in and put your money in a specific wallet that then sends it, and then you go and it does this protocol and it does shuffle everything and then get you your final payment out, that is definitely doable. But again, you have to think, when it comes to these technologies, it's a cat and mouse game. So if they come out with something like this CoinSwap, then Chainalysis is going to figure out a way to get under the hood of their protocol and figure out what's going on. Which is one of the reasons why I'm a huge fan of Monero, because while there is a blockchain, it's not viewable. There is no way for Chainalysis to look at Monero's blockchain or look at how much money you have in your wallet or where your last transaction was, because it's just not there, right? And even though there's a lot of speculation about, they figured out this Monero privacy vulnerability or that, at the end of the day, when people come out and say that they've cracked Monero, when it gets tested, it turns out that their findings are false and they did not actually crack Monero. But I digress. I could go on for this for hours and hours about the importance of privacy. But yeah, I think this is really interesting and something I'm going to keep my eye on, as well as, and I don't know if I haven't heard a lot recently, but there was the Mimblewimble project with the Kin and Beam token and then trying to implement that on Bitcoin. And I don't know if that fizzled out or what, but anyways, I digress. Thank you so much for watching. If you could, please give a like to the video, subscribe if you want, hit the notification bell, all that stuff. Really helps this channel grow and really gives me the motivation to make more videos. So again, my name is Danny K. This is Blockchain Breakdown. Thank you for watching, and I'll see you in the next one.